What's good, Kaneki? Welcome back to the channel. I hope you're all doing well. I am back from holiday after roughly 3 weeks in Ghana. I'm feeling rough though. I came back with a stomach bug, so you'll have to forgive me for not coming at this one with as much gusto as I used to. But hopefully I'll be fine soon. But this video, what am I going to talk about? It's going to be explaining different terms in the stock market, so CFDs, ETFs, and mutual funds. So I was asked to do this by a long-time viewer, and I thought, yeah, it'll be quite useful. It'll be quite useful for everyone to know about it. So here we go. But before we get into it, please hit the like button, subscribe as well if you're new and you haven't already. All right, I'm gonna start with CFDs. So CFDs mean contract for difference. The name of it doesn't really matter. Basically, what you need to know is that it is a derivative. Derivatives are very, very risky. I would recommend everyone stays far away from these as possible. But it's what people use to bet on stocks. So they buy a stock and they leverage it up. So whenever you see something like 2x, 5x, it means that they're buying 5 times the amount of stock that they put in. So if they put in £50 and they put it on a 2x leverage, they're then buying the stock for £100, but they've borrowed the extra 50. That's what it means. And it's very risky because if the price goes against you, if it goes down, something happens which is called margin call, where the broker says, okay, you need to pay us back. If you don't, we're taking all the money in your account. So I highly recommend staying away from these. Very risky. Just don't do it. The next one is ETFs. They are called exchange traded funds, I believe. And ETFs basically give you exposure to lots of different sectors in the economy. So if you think, let's say, the defense sector is going to do very well because of all the wars that are going on, you can buy a defense ETF, and this would give you exposure to all the stocks in the defense space. If you think healthcare is doing well, there's going to be a healthcare ETF. If you think AI is doing well, there's going to be an ETF for AI. The most popular ETF, I believe, is for the S&P 500, which is the SPY, or the VOO, which is the Vanguard. And on that note, something to know about ETFs, you have to look out for something called the expense ratio. This is the fees that they charge when you buy it. Some can be as low as 0.1%. I think Vanguard's VOO is actually is one of the lowest. If I remember correctly, it's 0.01%. Check the stats on Google. But yeah, you want to make sure that you're buying ETFs that have very low expense ratios, because the returns you get from it, what you should always do is subtract the expense ratio from that. So if you're getting a 3% return, which is actually very low for an ETF, if you're getting a 3% annual return from an ETF, but the expense ratio is 0.1%, your total return is 2.9%. That's how it works. And then you also have to factor in taxes from capital gains. So you want to make sure you're buying an ETF that is quite substantial. Don't just buy and sell every time it goes up or goes down, because if you do that, there are tax issues, because the more you trade these ETFs, the government would look at it as short-term holding, short-term investing. It's not really investing, it's speculating if you do that. But if you hold it short-term, the capital gains taxes are higher than if you hold it long-term. So really, you want to be buying and holding for the long term. And then mutual funds. Mutual funds, they're a bit like ETFs, but they are actively managed, which means there's going to be a financial I won't call it a financial advisor, but there's going to be someone buying and managing the stock holdings. So that's what they mean by actively managed. The ETFs are usually passively managed. So they just buy the basket of stocks and they just hold it. They don't trade in and out of it. But mutual funds, it's active. They trade in and out. They buy a stock, they sell a stock. This promises more gains. However, it is commonly known that most finance managers do not actually beat the S&P. So if you're going to invest your money in the stock market, you might as well just buy the S&P and hold it. Oh, I mentioned the SPY. The other one is the QQQ, which is for the Nasdaq 100. Uh, so yeah, just look it up online if you want to find all these ETFs. Just type the industry and then type ETF at the end of it, and you'll find something. But I would recommend the S&P, Nasdaq, or if you want an even larger exposure, so just all the stocks. I believe it's called the MSCI World Index. That being said, I'm not personally investing in the stock market, at least not in the traditional sense. So what I've been doing is I've been buying gold and silver miners. So if you want exposure to gold and silver without actually buying the metals, I don't recommend that. You should be buying the metals first and foremost. But if you want exposure to the gold and silver sector, a good way to do that would be to buy the GDX, which is the ETF for gold miners. And it's typically a good thing because when gold goes up, the profit margin for the miners increases, meaning the price ends up going up. Because when the gold price goes up and the cost to mine the gold usually stays the same or goes down, that's when the profit margin increases. So I think the GDS has actually outperformed the S&P 500 this year by quite a bit, to be honest. Unfortunately, I didn't buy the GDX. I've been buying the individual miners. I only hold two right now, two of them. But I say first and foremost, if I were recommending something, just buy the physical first before you do any of these things. Before you buy any CFDs or ETFs or invest in a mutual fund, get the foundation right. Buy some gold, buy some silver. Yeah, and to add to the point about taxes on your investments, in the UK, there's something called an ISA. I think it's called, is it individual savings account? If I got that wrong, I'll put the right abbreviate meaning of the abbreviation here. But I think it's individual savings account. There are lots of different ISAs. Um, Most popular one is the cash ISA. That is where you just put money in the account and it earns a bit below the interest rate that the Bank of England sets. I think at the moment the Bank of England has it at 4%. The cash ISA platform I use is Trading 212. I'll put a referral link in the description below. I think we'll both get some benefits out of it. So yeah, the one I use is Trading 212. I use that as more or less my bank, and then if I want to spend it, I just transfer it to my Monzo account. The transfers happen the same day. I think you just have to do it before 10 p.m. And you get the money the same day. So you can earn interest on it. It's very easy. It's very simple. There's not too much hassle with that one. That's the cash ISA. Unfortunately, Rachel Reeves wants to cut it down. The limit at the moment is 20K in all your ISA accounts, but Rachel Reeves wants to cut down the cash ISA limit to 4,000. They're trying to boost the economy by getting people to spend their money instead of saving. It's a bit mad, but yeah. So that's for the cash ISA. The next one is the stocks and shares ISA. If you buy any stocks through your stocks and shares ISA, you don't actually pay any capital gains when you sell them. I believe this includes dividends as well. So it's a tax efficient way of investing. I would recommend stocks and shares ISA if you are in the UK. That's what I use. That's what I started using. The next one I believe is the lifetime ISA. This one is for those who are saving for a down payment on a house, I think it is. You'll have to look up the benefits of it yourselves, just because I'm not too sure about this one. I don't know all the details, but I think it's 4,000 a year, and then the government pays some money into your account as well every year. Look it up. I'm not too familiar with it. So those are the three. I don't know if there are any more. So that's for those of us in the UK. In the US, I think you'll have your Roth IRA or something like that. So there are lots of tax efficient ways of investing in the markets. I'd certainly recommend that instead of the CFDs. CFDs are weapons of mass destruction. I think that's what Buffett said. Derivatives are weapons of mass destruction. So stay away from CFDs unless you really know what you're doing. It's a bit like betting. Expect to lose your money. And yeah, that's about it. That's about it for this one. If there are any questions, just let me know in the comments and I'll do my best to get around to it. If you want this advice to be tailored to you, message or email me on kanekikojo@gmail.com and we could set up a meeting. The first 30 minutes will be free, but future meetings will be at a fee, so we can discuss that on the call. So thank you guys very much for watching this. I am back. I will be uploading more. I'll also do another video on the trip to Ghana and the other holiday I took this year. So look forward to it. Look forward to it. I hope you enjoyed it. Please hit the like button, subscribe as well if you're new and you aren't already. And I'll see you in the next one. Peace.